Hello everyone, and welcome to the latest edition of Governance Watch, a Conference Board webcast series hosted in collaboration with the law firm of Cleary, Gottlieb, Steen & Hamilton. I'm Paul Washington, Executive Director here at the ESG Center of the Conference Board. The Conference Board is the world's leading nonprofit organization devoted to serving business and society for over 100 years, and the ESG Center is one of 5 U.S.-based think tanks at the Conference Board. We focus on corporate governance, sustainability, and citizenship. The Conference Board is a 501c3 organization, so we're committed to serving not only our members, but to society at large. And I'd really encourage all of you to visit our website to find the latest resources on addressing the health, economic, and social challenges facing society today. Today, we're going to focus on the 2020 proxy season. Unfolding in the midst of the COVID-19 pandemic, this year's proxy season was filled with a lot of challenges and some unexpected developments, which signal what companies might look forward to in the off-season and in next year's proxy season as well. I'm really delighted to be joined by 3 experts for today's discussion on the recent proxy season. Rick Hansen, who's Assistant General Counsel and Corporate Secretary at General Motors. Welcome, Rick. Helena Granis is Counsel at Cleary Gottlieb. Helena, welcome. And Francesca Odell, who's a partner at Cleary Gottlieb. Delighted to have you here. Great. Now, before we begin, and this is the really gripping part of the whole webcast, and you can stop after this, it's the housekeeping notes. And so I apologize, there are a few of them. But first, you can download the materials associated with today's webcast. There's a great slide deck put together by Cleary Gottlieb. If you click on the download section at the bottom of your screen, please note that you can only access these materials if you're watching this on a computer. Second, we are offering New York State CLE credit for participating in today's live program. For CLE credit, please download the CLE verification and CLE evaluation forms posted in the download section at the bottom of your screen. Complete those forms and email them to our friends at Cleary Gottlieb at the email address provided on those forms. For those of you who want CPE credit, you need to enter your full name, email address, and specify CPE in the request CPE credit space at the bottom of your screen. Please note that 3 pop-up messages will occur during the program to confirm your participation for CPE credit. So please click OK each time you see one of those pop-ups. Third, I want to underscore that we welcome audience participation today. Please ask questions at any time by entering them in the chat box at the bottom of your screen, and we'll do our best to work your questions into the conversation, and if we can't, we'll address them afterwards. Finally, a couple other housekeeping notes. Please complete the evaluation form for the webcast. This is separate from the CLE evaluation form. And at the end of this webcast, it really helps us hear your views and improve our webcast for the future. You can also share this program with your colleagues after the fact, as it'll be available on demand in a day or 2. If you want to see more of us, you can enlarge your screen to full view by clicking on the 4 arrows in the upper left-hand corner of your screen. And finally, for you to have the best viewing experience, you may want to close some of the other apps on your computer or other mobile device so that it helps with bandwidth. And so now, with all of that exciting stuff out of the way, let's talk about the highlights from this year's proxy season and what it means for the future. Before we get to specific topics, let me just ask a general question of our panelists. So what were the major developments and surprises in this year's proxy season? And we'll extend the proxy season to yesterday when the SEC issued its final rules on proxy advisory firms. So Francesca, do you want to lead us off on that?
And thanks to the Conference Board for having us. I think, well, as you mentioned, if we're including yesterday in the proxy season, I think that we saw a lot of interesting developments when the SEC came out with the final rules on the regulation of proxy advisory firms. So I would put that on my list, even though, as you mentioned, it's basically it's a little bit of a post-proxy development. I think, otherwise, the entire proxy season in some ways was a surprise because we ended up having most of it occur virtually, and the beginning parts of that were in such a state of flux as we moved from physical meetings to virtual meetings and physical workplace activity to remote working. And so a lot of that kind of shaped the speed at which issues moved and how companies dealt with them. So I think it's hard to talk about proxy season without talking about the impact that COVID-19 had on that season. And then I guess maybe another one on my list, and then I'll pass it over to Rick, is just the continued rise of ESG trends. And I think we've seen different aspects of ESG kind of come back and forth. And so we still continue to see a lot of E&S type activity, but I wouldn't count out the G activity either. I think it played a big role in this past season.
Great. And Rick, what was your experience? Big development surprises?
So let me just first acknowledge that I think Francesca's observations are spot on, and I'll keep my answer to this question fairly high level or list-like for present purposes, just because I know that we're bound to discuss a lot of these topics in greater detail, and I will acknowledge also that my list is somewhat duplicative of Francesca's list. But as I sort of look back on the 2020 proxy season, I think there were, at least in my mind, 4 major developments this year. One was COVID-19 and its impact on disclosures, engagements, and annual meeting formats. Second was what I perceived as an increased emphasis on and engagement about so-called voluntary disclosures and content, for example, human capital management, diversity in the boardroom and the employee population, corporate citizenship and responsibility, and of course COVID-19 related compensation decisions. Third, I would probably list the increasing success of E&S shareholder proposals. Francesca made reference to the continued rise of E&S issues, and we certainly saw that manifest in the success of certain E&S shareholder proposals, particularly those related to climate change and related to risks, human capital management, political expenditures, and lobbying activities. And finally, as was also mentioned by Francesca, I think it's pretty significant, yesterday's adoption by the SEC of amendments to the proxy solicitation rules and their impact on proxy advisory firms. And I know that we'll have more to say about that here in just a few moments.
Yeah, thanks, Rick. That's a great outline of actually the topics we're going to delve into. So thank you for that. And so let's talk about, Francesca, yesterday's release of the final rules from the SEC. They're almost 250 pages long, and I kind of feel like I've shown up to a book group without actually having read the whole book. So trusting you to have done so, can you give us a little bit of the Cliff Notes version of what you think about the
Sure.
the
and I was just
final
going to say that we're coming out very shortly with our Cliff Notes version, and we'll send out a little bit more digestible summary of those rules. I think, as you mentioned, it's hot off the presses, which is fun for an event like this because we can talk about it real time. There weren't a ton of surprises, I think, other than the timing and the speed at which maybe they adopted the amendments here at the tail end. As you guys know, there's been a ton of controversy around the amendments and lots of comment letters and opinion pieces and commentary on comment letters, which is a lot of that 250 pages, to be fair. But, bottom line, I think the new rules reaffirm that proxy voting recommendations are a solicitation. So that should, although not super exciting and not different from what the SEC has said in the past, it will impact that ISS lawsuit that's out there and that presumably won't be stayed any longer. And so that'll be something to watch. Most folks skip this next step, but the regulatory hook is that, since proxy solicitations are subject to the content requirements of Rule 14a, proxy advisors have an exemption from those filing requirements, and that's always been true. But what these rules really do is they just add more conditions to those exemptions. So the conditions that they add are, the requirement that proxy advisors disclose conflicts, and the requirement that proxy advisors give companies access to their reports before it goes to investors, and then And then there's the last piece which says that, you know, they need to find a way to communicate to investors anything material that companies end up saying in response. But that's where there isn't quite as much detail. I mean, everything after that is pretty much consistent with some of the recent rulemaking, principles-based, and there'll be some time before that piece of it is effective. I think the last thing maybe I mention is, and then we'll turn it over to Rick, is that the SEC did back off from that prescriptive speed bump mechanism that that brought about a lot of discussion, and it kind of took this approach of, okay, here you go, you know, here's our framework, and you know, be careful out there, right? So I think it'll be interesting to see how that develops.
Yeah, interesting application of the principles-based sort of approach in this field. Rick, given the timing of these rules, the potential for litigation and so forth, from your perspective, what do you think companies should be thinking about doing now? Do they sort of wait and see? Does this change the environment for engaging with proxy advisory firms or your investors in the near term? What are your thoughts?
I don't know that this will have a tremendous impact in the near term. The effectiveness of the rules is not for quite some time, which frankly, in my view, means that we are likely going to continue to squabble over these rules and the impact of these rules for the duration of that period until the effectiveness. As you have mentioned, ISS has litigation pending against the SEC regarding the substance of the rules. That stay is effectively now lifted, so I expect that litigation will proceed, and that may have an impact on final implementation of the rules as well. I suspect that we are going to see a considerable amount of commentary on the proposed rules and a request for guidance as to implementation of the proposed rules from the staff. And so my sense is that although this is an important step in the process is far from over. And of course, we have the wild card of upcoming elections, right, and what that might possibly mean for the composition of the commission and leadership of the commission, and whether or not, if there's a change in leadership, that leadership has the desire to continue on with these these finalized rules, or perhaps make even additional or modest changes to them as well. So I think the landscape remains somewhat uncertain. I will just confess that the release having come out last night, I've not had an opportunity to study it in any great detail, and I suppose that many of my fellow issuers that are on this call are in the same position as well, and we've just adopted a sort of wait-and-see attitude for the moment.
Right. So good news for everyone who's watching. You can take your time to read this, or tell tell your board that it's okay. Right. You can take a little bit of time to digest this. So, Rick, you know, one thing you flagged earlier was the impact of COVID, and Francesca did the same on this proxy season. And I'd like to delve a little more deeply. Both, you know, generally things that were voted on this in this most recent proxy season were relating to last year's performance and so forth. But there were a number of ways in which the pandemic affected both the substance and the process this year in the proxy season, and would love your thoughts about that and maybe what you think it signals for the future.
Sure. I think it's clear, as has been mentioned, that COVID-19 and company actions in response to the pandemic had a substantial, if not game-changing effect on the 2020 proxy season. And I also think that we are likely to be living with those effects for quite some time. Maybe just by way of one discrete illustration, I recently hosted a panel discussion for another organization, and that panel discussion focused on COVID-19 and executive compensation matters. As we discussed on that panel, and as I'm sure many on today's webcast are aware, COVID-19 had and will certainly have a dramatic impact on current year compensation programs, objectives, and metrics, and will continue to assume center stage next year when companies are required to explain their compensation decisions for 2020 performance. So we are certainly going to hear more about those types of decisions in the season that follows. In general, I think there's a long list of ways that COVID-19 affected the 2020 season and will affect us in future seasons. I think this is due in part to the fact that COVID-19 really laid bare the urgency of a number of issues that have been percolating for quite some time, such as board oversight of risk, human capital management, corporate citizenship and responsibility, compensation, and company and shareholder relations. Let me just highlight, I think, 4 additional ways that I think COVID had a direct impact on this year's proxy season. One is just the nature and content of investor engagement. Investors are increasingly wanting to hear about a company's views on human capital management, employee management relations, and corporate citizenship and responsibility. Secondly, the nature and content of proxy statements and other disclosures. What I said about the nature and content of investor engagements holds true here as well. At GM, we filed our proxy statement in late April, well after the onset of COVID-19 here in the U.S., and it's fair to say that we modified and augmented and even inserted new disclosures into our proxy statement to be more responsive to the current environment that had come to the, and issues that had come to the fore as a result of COVID. Certainly the format of annual meetings was an important, if not controversial, issue during this past proxy season. I recently saw some data which suggested that in 2019, just 8% of Russell 3000 companies held virtual meetings. Of necessity, this year that number has already shot up to 65%, and many companies, I think, handled the transition well, but admittedly, many did not. But what is clear is that many service providers and many companies, I think, were simply not ready for this change at the time it needed to be made, and already the battle lines are being drawn for the off-season on the future of virtual meetings for next year. And finally, I don't know that this is directly related to the proxy season itself, but it is a matter which will ultimately come to the attention of shareholders and likely up for shareholder voting, but that's the adoption of poison pills. Many companies chose to adopt poison pills in recognition of COVID-19's impact on the equity markets and the corresponding impact on share values for individual companies. And the prospect of opportunistic activism really forced or convinced a lot of companies that now was the time to adopt a pill. Many of those pills of necessity will be short-lived and of course, subject to scrutiny by ISS and Glass Lewis. And so certainly they may become a topic of shareholder interest in likely voting. And if you'll pardon me just for the lengthy answer here, I do hasten to add that I think it's fair to say that COVID-19 was not the only exogenous shock, if you will, to the engagement proxy and annual meeting season this year. I want to be very clear in acknowledging that our nation seems to continue to struggle with issues of race and justice, and that issue also had a significant impact on this season, and I think will have an impact on future seasons. We'll see that in the form of new and urgent calls for corporate commitments to diversity, not only within the company themselves, but in the communities in which those companies operate, for new diversity disclosures. And I'm sure that we're going to see this issue in the form of shareholder and the like. We'll come to this point, I think, a little bit later in the program, but just to briefly illustrate, as I'm sure many of you are aware, the New York City Comptroller's Office, which acts as steward for the New York City Employees Retirement System, has already sent letters to all of the companies in the S&P 100 requesting that those companies begin publicly disclosing their consolidated EEO-1 reports, which reflect race, ethnicity, and gender of company employees. So certainly a lot of impact from current circumstances.
Yeah, and we'll get into some of those, especially the issues of diversity, racial equality, racial justice later on too, because I think we have to, in some ways we're using COVID-19 as sort of shorthand, but it's really the combined health, economic, social, and indeed political crises that have arisen this year. Helen, do you have anything that you'd like to add about the impact there in terms of the current season? Maybe, any reaction on some of, Rick mentioned some of the defensive measures that companies have put in place. Has there gone any reaction to those sorts of things?
Yeah, and Rick's list was a really good one on the impacts of COVID-19. I think a few points to echo what he said on the defensive measures. I think they were, largely well accepted, and companies were able to adopt them quickly and easily. I think it really remains to be seen as we go forward whether that whether that ability to do so continues as we progress, and as the stock market has become less volatile. Maybe it will go back. We don't know. So on defensive measures, I think it remains to be seen how accepted they are. I think two other pieces that Rick mentioned. One, thinking about the engagement as people head into the off season. As he mentioned, everyone moved quickly and furiously to virtual meetings, and there's a lot of plumbing in that, which I think we'll see very quickly on the technical side. But I think it will be a real area of engagement for companies that like the virtual meeting format and would like to continue it, to engage with their shareholders. I think the large majority of institutional holders are still largely against virtual-only meetings, although there was some movement to at least the fence by some. So engagement, if you're going to have a virtual-only instead of just a hybrid meeting, where you do both a physical meeting and the virtual. I think the other big piece was the workforce protection and health and safety, which will continue to be a large area for engagement as companies reopen in phases, and maybe reopen and close again. So as we move through the rest of the summer and the fall, when people are really engaging with shareholders, I would expect that to be a first question. What are you doing for the workforce? And also, as Rick was talking about compensation, the idea of capital allocation. How are you thinking about capital allocation in light of workforce health, safety, stability, weighing that against other things that you could do with cash, compensation, share buybacks, which we saw very few of. Most of those programs were cut, and dividends. So all things for people to consider.
Right. Excellent. So, and this leads to a question about shareholder engagement, which I want to ask Francesca about. But one thing I think is clear is that in the off-season, companies need to allocate more time, very practically, for their conversations with investors. As Rick noted, it's changing the nature and scope of these discussions, and to have a meaningful conversation about things that are, okay, what do you think about virtual meetings? Shareholders, give us your thoughts, because that may be the trend in the future, but what do you think we should be doing? It could be as simple as scheduling your meeting at a different time when people on the West Coast can attend, or something like that. But what are things we should do? And then these very deep questions of, okay, what's the company doing on social issues? What's it doing in terms of employee health and safety? What's it doing in terms of customer health and safety, right? How are you helping to bring your customers back as well? So I think as a practical matter, allocate more time in the off-season and engagement. And Francesca, maybe you could talk a little bit. Rick has flagged some things about this season's engagement. Maybe you want to touch base a little bit more on what you've seen in terms of the engagement recently, and anything else you might see about what's coming down the pike.
Sure. And the way you summarized it is exactly right. I mean, back in the day, there used to be shareholder engagement when a shareholder proposal landed at the company's doorstep, and then there was back and forth about trying to reconcile that shareholder proposal. Then over time, I think folks realized the importance of having what we call kind of sunny day type engagement, engagement with shareholders when there's not an imminent or threatening issue right there, but getting to know your investors and your stakeholders a little bit better. But what Rick said is so true, that investors have so much more information and they're demanding a lot more engagement. And that's a wide variety of investors, to be honest. I think companies, as a result, have become a lot more focused on their engagement strategy, not just in a pre-proxy season run-up, but in a continuous sense. I think also, too, as we've seen, the large institutional investors, as well as, I guess, the proxy advisory firms, have been very vocal about different positions that they're taking on different types of issues. And so companies are aware of those positions, and you can see based on the proxy season results, and there's a lot of information on this in that deck that we posted, but companies can see what the hot button issues are, and you can extrapolate from that where there might be attention in the upcoming season. And so I think that facilitates a lot of those conversations, and there's just a lot more intelligence out there in both directions. The other thing that I'd say is that I think that there's just a lot more people in that room, right? It's not just someone from the investor relations team talking to the relationship person at a big institutional investor. The institutional investors have very strong stewardship programs on all sorts of issues, from climate to sustainability to human capital management. And so a lot of those large institutional investors are coming into those rooms very well informed, not just with respect to that particular company, but with respect to the market more broadly. So I think that it's a more crowded room with many more voices in those engagement discussions. And so I think that has an impact as well. The other thing that we've seen is that when you look at shareholder proposals, and we're going to talk about this a little bit more later on, but when you look at shareholder proposals, the number of withdrawals of proposals has actually decreased, which means that proponents just aren't as willing to give in. They want to have more of a back and forth, but they want to have more of an impact. And I think that will lead to even more engagement, right, in the lead up, because companies are going to want to be in a position where they understand those issues far in advance, and they hopefully avoid a shareholder proposal in the end.
Right, and I think all of this leads to the importance of having a really clear, with more people in the room and more topics. It's like a board meeting, right? You have to have a clear agenda for your engagement. And I think so you really want to agree on that with the shareholder to whom you're talking. And I think what I'm also getting a sense is that companies probably need to be a little bit more in the listening mode. I think that's shifted over time. Initially, it was, okay, here's why this shareholder proposal was so bad, let's kill it, right? And then it's a little bit more two-way. But I actually think that what you're suggesting is assume that your shareholders are pretty aware of what your position is and what's going on. They're coming in with their own views. And so this is really an opportunity. Maybe if it was 50-50 before, it may be a little more 60 listening, 40 talking now. But we'll see. So let's turn to the specifics of the E&S types of proposals. We heard that there were, continue to be a lot of them, fewer withdrawals, so proponents are sticking with it. Helena, any other comments that you might like to bring forward on the E&S proposals? And I would suggest people read Cleary's excellent deck on this, so you'll get all the detailed information. But Helen, what are some of the highlights?
So some of the highlights, I think as we've said, there were more E&S proposals this year combined than governance proposals altogether. So over the years, I think that trend is continuing, where E&S really becomes a big piece of what people are talking about. On the environmental front, as Rick said, climate change really led the way, with a number of proposals passing, getting majority votes, and a number coming close. So those proposals were largely around reports on lobbying, reports on impact, reports on how companies were looking to get to the Paris Accord levels. With those, I think there were a couple that are good examples. One was Chevron, which had a shareholder report shareholder proposal that ended up being supported by BlackRock, by BNP, one of its large investors, and that was on a report on how its lobbying efforts accorded or didn't accord, sorry, too many accords, with the Paris Accord. The other was Phillips 66, which had a proposal pass on a report for chemical facilities and the impact of those on their environmental platform. So others came close but didn't pass, but I would fully expect that that's something that we'll continue to see, as well as other developments in climate. On the S side, as we've touched on, diversity and human capital management, as well as human rights, were really the key proposals. On the human capital management, things like Chipotle had a proposal to do, again, a report on mandatory arbitration clauses and how those affected employees, sexual harassment and things, reporting of sexual harassment and similar employee issues. And then we saw a few board diversity proposals passed. Sorry. I think that as we go into the next season, which I know we'll talk a little more about, as we talked about the anti-Black racism, the protests, the awareness of violence is only going to put more emphasis on those social proposals as we go forward.
I think that's right. So, Rick, you had 4 proposals this year, a couple governance ones, a couple social ones on lobbying, human rights. Any observations about your experience with ES or G proposals this year that you'd like to share?
Simply, my observation is that I think that support for these types of proposals continues to grow, and I think the data bears that out. As you mentioned, we had 4 shareholder proposals this year, evenly split between 2 governance-related proposals and 2 E&S proposals. The first requested a report on the company's implementation of its human rights policy, and the second requested a report on the company's political and lobbying activities. Neither of the proposals passed, but in each case they did achieve new levels of support over prior years and were again supported by ISS. If I recall correctly, the human rights policy proposal received about 30% support, and the lobbying proposal received approximately 33% support, which I think, as I mentioned, is indicative of this trend of increasing support for E&S proposals that we saw at GM. Is indicative of what we're seeing across the industry, within the shareholder proposal community generally, and Francesca has noted that. I will say that 2 things that were of particular interest to me during this current season was we did see an increase in the number of shareholder proposals, not at GM, but in the shareholder proposal world generally related to human capital management. Mm-hmm. And as we look forward to future years, I think that this is an issue that's going to stay with us in the form of shareholder proposals. But just a couple of examples that I noted from this year. At Genuine Parts, Fastenal, Fortnow, and O'Reilly Automotive Insurance, 4 healthy and rather large companies. Each of those companies had a shareholder proposal related to human capital management, and the minimum level of support was actually Fastenal for 61% support. Fortnow, Genuine Parts, and O'Reilly Automotive were well in excess of 70% support. Proposal, which I think suggests that issue is not going to go away anytime soon, and probably rightly so. The other proposal that I kept an eye on this year, which received quite a bit of attention but only broke the majority threshold, at least in one case that I know of, was the New York City Comptroller's Rooney Rule proposal, which, as some of you will probably recall, sought the adoption of a policy requiring that for board and CEO searches, at least 1 woman and 1 person of color be considered. That, too, represents an issue that I think in a larger manifestation of issues of cultural, race and ethnic diversity, cultural development, race and justice, I think are going to continue to be with us over the next few years.
Yeah, really, really helpful points on those. So let's pause for a moment and actually ask the audience. I think you've already given them a little bit of the answer, but we'll do a poll question of the audience if we could pull that up to get your views on the future of what you see in terms of, will there be a significant increase in the number of shareholder proposals or in E&S issues in both areas, just in social, just in environment, not much change, or you don't have much of an opinion? Keep this open for a bit.
I like seeing the numbers move as the votes.
Yeah, this is real time. This is kind of exciting. This is what passes for gripping television in the governance world, right? You get to see the results come in. Okay. All right. give it a few more seconds, and then we'll, like a shareholders meeting, we'll declare the polls closed. So why don't we do that right now? Okay. So, you know, Helena, what's your reaction to this? You can see that about, you know, you have a very small percentage, so it's under 10%, think that there's going to not be any much change, or under basically 5%, not much change or no opinion. Only about 4% think it's really just going to be an increased focus only on environmental, but most think the focus will be in both areas and especially in social. So I think that makes intuitive sense to me, but what's your reaction to that? What do you see?
I agree. It makes intuitive sense. I think one of the interesting things that happened as we went into COVID and into the anti-racism protests was we lost focus a little bit on the climate change and environmental proposals as being top of mind. I think we went into the year thinking climate change, sustainability is really the top on every investor's mind after the BlackRock letter, and so I think part of what we're seeing is yes, the rise of social proposals, but I think we'll keep the environmental proposals strong and probably swing back to them as things equalize. I think we'll continue to see, as Rick said, not only an increase in proposals, but an increase in support and an increase in the depth of the proposals and the types of proposals. So diversity proposals are moving from just looking at the board and CEO to looking at all of management to looking at general worker gender pay gaps to, as we said, the EEOC diversity classifications. So that gets broader. I think we also look at shareholders getting deeper into these issues, looking at whether companies' lobbying money is spent in ways that backs up what they've been saying on social issues and on climate change.
Got it. So let's drill down a little bit after I do a CLE code announcement. Before we go on, for those of you who are interested in obtaining CLE credit, the verification code which you need to include on the verification form is 12192. That's 12192. Okay, so commercial break, back to our discussion. Francesca, so Rick and Helen have mentioned it, and I think we're all aware of it. There is this increased focus on diversity, and until now, it's largely focused on gender diversity. We expect that to change in the future, and we can get a little bit more into that. But what did we see this year, this most recent season, in terms of diversity proposals, how they fared, and then, again, a little bit, how do you see that evolving? And then we'll talk a little bit about what companies might be thinking about doing to respond to this evolution.
Yeah, I think...
oh, go ahead, Francesca.
Oh, sorry. No, Rick, you start.
I was going to say, I'm going to defer to Francesca and Helena to give us the stats on diversity proposals, and maybe I'll jump in after that. Okay,
great. Great.
So I think on the, you're very right that historically, proposals have been much more focused on gender as opposed to racial diversity. And so this past year, we've seen a lot of proposals on gender pay equity, as well as some overall workforce diversity proposals. And I think generally investors are placing a lot of pressure on companies for focusing on board skills overall and how those are being satisfied. But that, the gender focus has been one that I think, although is extremely important and will hopefully continue, has historically taken on more presence, I guess, than the focus on racial diversity. And we saw that during the season when everyone from, Goldman Sachs decided that they're only going to take companies public if they have at least one woman on the board. And BlackRock has come out and made a number of different comments. But I think what we started to see as proxy season went on, and this doesn't affect the proposals during this season quite as much, but we saw a tendency to shift, and investor focus was much more on racial diversity. And that's obviously in part because of the crisis that our nation is going through and the extreme acts of violence and anti-Black violence in particular. But I think it's also because certain populations are adversely, affected and have been impacted more by COVID than others.
Right. And Rick, please share your thoughts, if you could, on this issue of diversity proposals.
Well, I think that, Francesca's comments are spot on. One just generalization that I'll make is we've been talking about diversity in the boardroom and the employee base for quite a long time. I do think that over the last few years, the pendulum has shifted almost exclusively to a discussion of gender diversity. Mm-hmm. I now see that pendulum moving back towards a more traditional notion of diversity, which is not just gender diversity, but also race and ethnic diversity as well. And I suspect that trend is going to continue. Maybe what I'll just share by way of illustration is just some insights into what happened during our engagements this year on this particular issue. I would say that over the last 8 to 12 weeks, in the run-up, to our annual meeting in mid-June, which was, of course, during the height of a lot of the civil unrest that was occasioned by some really unfortunate things with respect to race relations here in the United States. It would not surprise you, I think, for me to say that those were part of our engagements and part of our conversations. Having reflected on those conversations with the folks that we engaged with, and that includes both investors and other stakeholders, it's really become clear to me that investors and other stakeholders are looking for action and evidence of that action in 3 ways. One, they're looking for it in the boardroom in terms of both the board's makeup and what's on the board's agenda. 2, they're looking for it in the employee base. And 3, they're looking for it in the communities where companies operate. And this is both an internal and an external issue as well. I mentioned those 3 areas. Maybe just to elaborate further, I would say that, in the boardroom, I think what this means is, among other things, number one, that the board itself is diverse, not only in terms of gender, but also race and ethnicity. And I also think that diversity is expected to be, and we should be demonstrating the fact that it is a frequent topic of discussion at the board level. And through reasonable disclosure practices, companies need to have a conviction to provide investors and other stakeholders a window into what those discussions are like and what the board's priorities may be. With respect to the employee base, what I think that means in terms of not just words but also actions is that, among other things, companies walk the talk and seek out, hire, and retain diverse employees. And here, too, that through reasonable disclosure practices, companies have the conviction to disclose employee demographics and diversity efforts so that they can be held accountable. There is an expectation on the part of many large investors that corporations will speak to this issue and that they will be held accountable for it. And then finally, I mentioned the desire to see not just words but also actions in the communities in which companies operate. And here I think this means that, among other things, that companies are more than simply paying lip service to diversity, rather that they're throwing their weight behind public policy and other national, state, and local initiatives to address diversity and racial injustice in a concrete way.
Yeah, I think that's very important, especially that there's a growing awareness that public policy, the government relations public policy arm of your company needs to be involved in this, and that that effort is not just securing an additional tax break, though that may be important. It's a broader agenda for companies. And I'd add to your list, it's also what your company's doing in the marketplace. So it's workforce, workplace, public policy, what's happening at the board level. And I think some of it's also what are you doing in the marketplace? How are you making sure that your products and services, both in terms of what you are acquiring, your supply chain upstream, and then what you're offering is serving a multicultural audience in an equitable manner. So I completely agree with your list. So, one thing, Francesca, if you just talk a little bit briefly, because I'm conscious of time here, what should companies be doing? I think Rick has a good list, but one issue here is in disclosure, right? And right now, based on report we're going to be coming out with soon, it looks like only 10% of the S&P 500 discloses racial ethnic diversity on their board. Seems like there's an opportunity to get ahead of the curve. But when you're disclosing it, do you follow the EEOC guidelines? Like, what should companies be doing if they're really trying to at least help check off one or two of the boxes that Rick mentioned in terms of diversity?
Yeah, it's a tricky question, right? Because on the one hand, I think that the investor public wants to see information on this, and they want to see improvements throughout corporate America, right? And then a separate question is, what should companies be disclosing, and what kind of statistical information is useful, both to see the current status and to see change. And so you mentioned the EEO1 report data, and the New York City Comptroller has focused on that a great deal, and ISS has also come out and urged companies to disclose the ethnicity of directors. I think we should be careful not to think that the EEO1 report data is going to save us all from this issue and provide us with the kind of information that will be important. I think that that form is from a number of decades ago, and I think probably does not capture diversity the way that many of us think about diversity today. It's very binary in terms of questions about gender. It's very limited in terms of questions about ethnicity because it doesn't recognize multiple ethnicities, which is something that we think about a great deal when we think about diversity. And so although providing information is important, I worry a little that those categories might not be quite as helpful. And in addition, there are, I think 10 or so categories of where employees fall in that, and those categories aren't always representative of a company's business. And I think what we should be looking for is disclosure that's actually helpful, and so that investors can understand what the company's diversity goals are, and then also how they're doing in meeting those goals. And so I think there is a tendency to get caught up in the type of data that's being provided as opposed to the strategy of the company and whether there is improvement on that strategy. And I think that's going to be something that's going to get a lot of attention in the coming months.
And I think we just got to comment in on this. Part of this is building diversity, both demographic and cognitive diversity, deeply into your director recruitment, onboarding, and engagement processes. And this isn't one of those things where, okay, we've got 2 women, okay, we've got a couple of people of color, we're done. No, this is an ongoing embedded set of processes that companies really, it'd be in their best interest to embrace, so that this isn't a sort of check the box exercise. Human capital management. We've actually touched a little bit on workforce and workplace. It's a big topic. We at the conference board have a working group focusing on board and shareholder oversight and other stakeholder oversight of human capital management. Should be coming out with a report this autumn on that. So major focus for us, for investors, for companies. Francesca, what kind of conversations are companies having with investors in particular on the area of human capital right now?
Yeah, I mean, investors have been really vocal on this issue. And there have been lots of letters out there, right? The, Council of Institutional Investors and the SEC's Investor Advisory Committee has been very focused on this issue. And so there's been a lot of urging of the SEC to provide more guidance for companies. Everything from disclosure about hiring and layoffs and safety measures and a lot of kind of COVID-related matters. As well as just overall things about even as broad as overall human capital management practices, supply chain risks. You talked before about customers, there's customers, suppliers, so it goes kind of throughout the gamut. And I think that the conversations that companies are having with investors right now is a balance in part because those companies want to have a lot of discussions internally, want to comfort their workforce and make sure that investors also understand that they have a clear plan and that there is a path. Most of the time, it's true that when companies are handling their human capital well, that they're performing better. And so it's an indicator of whether the company is up to the challenge of handling this difficult time. And so companies are having a lot of conversations with investors. You have to be a little bit careful about material non-public information and what kind of information companies are providing both internally and to other stakeholders, and then how that balances with public disclosure. I think the SEC has indicated that they're going to be accommodating in terms of that type of disclosure, that they understand that people want to see it and that they're encouraging companies to do it. I do think that companies still need to be cautious on that disclosure front. A lot of it is very forward-looking, and it's very difficult to understand where things are going to go from here. And so a slightly cautionary approach to that kind of disclosure, I think, is important. But human capital management is definitely going to be at the forefront for quite some time, and my guess is very much at the forefront for next proxy
Right,
season
and part of that disclosure, I think, no surprise coming out of the work we're doing, you really need to link your workforce to your company strategy, and your workforce strategy to your company strategy. That narrative is going to be almost as important, or maybe more important, because it provides context for all the specific metrics. And unless you have that clear discussion within the boardroom and then with your investors and other stakeholders, all the metrics in the world aren't all that particularly meaningful. So that's key. So Rick, if we could just turn, as we came into the year, everyone was talking about the BlackRock letter, about the State Street letter, big focus on sustainability and climate. Just curious how those letters affected your interaction with your broader shareholder base, and whether you see that same sort of pattern continuing in the future with a couple letters. How much did they set the agenda, or didn't they, and how do you see that evolving in the future, do you think?
Well, the short answer to your question, Paul, is that I think these letters are very important for reasons which I'll describe in just a minute. And I do think they're going to be part of the landscape, an important part of the landscape for years to come. And I think they're valuable both to the corporates, to shareholders, and to other stakeholders as well. Your question was directed specifically at the impact that these very thoughtful letters have had on our investor base and our engagements with shareholders. But before I go there, let me just speak to the impact of these letters on our board and our company, which I think is an important issue. As of today, BlackRock and State Street are two of the largest institutional investors in the U.S., if not the world. They are top 10 shareholders at GM, and I suspect top 10 shareholders at many of the companies who are represented on this webcast today. And I think that fact alone suggests that these letters ought to be taken seriously. I would also suggest that these letters ought to be taken seriously because they've proven to be fairly accurate predictors of the topics that are going to be foremost in the minds of many investors in any given season. We, meaning GM and its board, in fact, take these letters very seriously. The letters and our responses to the letters are reviewed carefully by our senior leadership and our board, and we use them to gauge and understand the concerns of the larger investment community and as somewhat of a roadmap for issues in the coming and following seasons. Now, as to your question about the impact of these letters on our broader investor base, while I think they're important, I can really only describe my personal experience. It is interesting to me how many other very large investors will ask us about our views on the BlackRock and State Street letters and pattern their own engagement agendas after the content of those letters. And I'm not in any way suggesting that that's bad, but what I am suggesting is that is proof to me that these letters are having a far broader impact than might otherwise be assumed.
Mm-hmm. That's interesting. And they're having an impact directly in your boardroom. They're having an impact with investors, and that's partly because they resonate with these other investors, right? The other investors aren't just going to follow someone else's lead or their leading words unless it makes sense for them. So that's really interesting. Let me ask, one issue that came up in both of those letters were the reporting frameworks, SASB, TCFD, and there's an interesting dynamic here. Money flows into ESG funds despite lack of standardization and so forth. There are issues with every reporting framework, with a separate issue of rating agencies. But Francesca, are we seeing a shift now with investors on how they're viewing these reporting frameworks? We've seen TCFD sort of take off. We haven't seen SASB take off that much yet in terms of company disclosures. Curious what you're sensing is happening in conversations with investors on these reporting frameworks and what that might, say about the future.
Yeah. I think part of it is just that there are so many that it takes a really long time to start.
We have the 20 categories on Davos, right?
Exactly. And so, IFS has its own, State Street has its own, and I do think that TCFD and SASB are kind of emerging as the most recommended reporting standards. And I think kind of following BlackRock's example, there is also a movement toward integrated reporting. And I think that it's going to take some more time before there's any kind of consensus around this. I think it's a little bit distracting because there are all these standards, and it makes it a lot harder to see whether there really is progress, and there's potential gaming for which standards are going to be used and things like that. So I think that hopefully we're going to emerge with a couple of standards that are going to be more widely used, and that'll allow a little bit more consistent comparison among companies. But it's moving very slowly, as you mentioned, and I think it's still going to take some time.
Got it. So let me do one more CLE verification code, that is 12192, and then a quick, really sort of lightning round wrap-up question. If you have one piece of advice for companies as based on what you've seen in this proxy season as they're moving ahead, what would it be? Francesca, do you want to lead off? One key takeaway. It's completely and utterly unfair question, although you were prepared for this.
No, I would say engage. I think, and engage particularly on human capital management. I think that's going to remain a focus and be a prevalent concern into the coming season. And I think the more that companies can engage around that, especially in advance, the better.
Great. Helena, and then.
Yep, I think I agree with Francesca. I think it's also remembering that you need a cohesive approach. So you need the board and the C-suite and your legal group and your IR and your sustainability people to all be on the same page and thinking about long-term value, and stakeholders as well as shareholders in the same way.
That's a really important point, also something that we've found within the conference board's own work, where within the C-suite they're not necessarily talking to each other. There isn't a consensus view within a company on a particular topic. So, Rick, over to you. Big piece of advice.
I'll make this quick. You need to decide now if you're going to have a virtual shareholders meeting next year. If you do, you are obligated, in my view, to do everything you can to make it as shareholder-friendly and in-person-like as possible. Don't wait until February or March next year to get started.
Great advice, very practical, and thank you all for really extraordinary contributions. I hope people actually watch, even if you watch it live, I hope you watch it on demand again, because there's a lot here, and please download the deck. I just want to note on the screen you'll see a number of resources available about upcoming webcasts, about what the Conference Board is doing relating to the multiple health, economic, and social crises facing the country and indeed the world these days. So thank you everyone for joining us. Thank you again to the panelists for such a thoughtful conversation. And please, for those who are watching, please complete the evaluation form. Be safe, be well, and look forward to the next time we're together. Thank you.
Thank you.
Thank you.